Good afternoon, everyone. In today's video, we're going to take a look and focus on the S&P, the Nasdaq, the Dow, and the Russell. We'll take a look at both the futures along with the actual ETF, and then use things like Fibonacci and our different indicators to try and figure out, was last week's activity just a minor pullback in an otherwise still intact and healthy uptrend, or should we be expecting slightly deeper corrections in this upcoming week? All right, so let's first start by loading in the utility labels. I think that's a good first place to start. And the one thing I want to call out here is our put-call ratio. Now, our put-call ratio has been signaling to us for quite some time now, so it's not like this is a recent alert that we have way too many folks who are long the market, and that should be a reason to start to expect the markets to correct, right? It's that tactic where when too many people are long, you expect the market to essentially take their lunch money, start to correct, reverse violently, stop all these people out, stop out the weaker hands, before ultimately coming back in, buying the support, and then propping the market up higher, leaving most people on the sidelines. Now, if we keep that perspective in mind, we're seeing that there's a couple things here that call out for us to be a little bit more cautious or bearish looking, right? And that's with both the trend and the put call ratio. Now, if we bring this down to our S&P futures and we come to a 1-minute chart and we load in the aggressive volatility box, which is the one we had to use Friday morning, we had a breach set up in which price fell through our volatility box sign lines. We got the edge signal. This is it. This is the setup we're looking for. But the buyers were unable to drive the price up any higher, and instead we were stopped out of this trade. If we contrast this with the Nasdaq here, the Nasdaq looked similar, but a little bit different, just a slight little nuance in which we had price breach that volatility box line. You had the edge signal, we stopped outside, but you saw just a little bit more buying pressure in the Nasdaq, suggesting that between the S&P and the Nasdaq, more folks were willing to buy the QQQ if we were to extract this to the actual ETF. Now, if I contrast this one more time with the Russell did respect our actual entry line, and you ended up getting the bounce just like we were expected, right? This is our normal setup in which price falls at our sign lines. We see price reverse. The last time we saw both the S&P and the Nasdaq fail, that was when we had to also introduce in things like the doomsday models to try and accommodate the volatility before that February and March drop down. So that's the one thing I'm a little bit more cautious of, is trying to assess whether or not this is a period similar to that February-March period, or again, just a very normal pullback, right? And that's where I think now we'll start to layer in our actual technical analysis on the larger ETFs. And this is again with more of a swing trade picture in mind, but I'll give you reasons for why I think both bullish and bearish, along with price areas that I think price may fall to before we start to see this bullish turn. All right, so if we start with the S&P first, and this is the SPY ETF here, and we draw our swing high to swing low, what should stand out is the 786 is currently acting as that period of resistance, right? That's 313.22. The S&P tried to break above. That was then failed. We retested, again failing from it. And with Friday's close, so far looks like we should be expecting more downwards movement. If I also load in the volume, this should have been on high volume, if you take a look at that, where we had greater than average volume, 1 day, 2 day, and 3 days in the S&P futures, which would again suggest more and more selling, where I think you may have a slightly longer term pullback here instead of seeing the S&P just perk up right away. Now, that's not to say that I think the trend is broken. I just think that you may want to be a little bit more cautious and have levels in which you're waiting for price action to fall a little bit lower before you're ready to buy. Now, if I contrast this with the Qs though, the Qs stand out a little bit because we have this massive cluster right here. So a lot of lines, let me actually get rid of this latest cluster first, or the extension, excuse me. What should stand out is this cluster right here between 239.05 to 234.56. This cluster is made up of a few different things. So we have our swings that I've projected here, and this is just to see, do we have any sort of symmetry? And there we see that the Nasdaq has a good amount of symmetry. Most of the swings in this otherwise upward move all stopped within the same zone. We also have the anchored VWAP from that May 14th level, which comes in around that same area, and the market pulse line, all to say there's a good amount of confluence at this zone in which you may expect the Nasdaq to bounce into here, chop around sideways, and then start to pick up from here, and maybe even look at something like the 250 butterfly as a very low risk way of playing this move once price action falls into our zones and we get some sort of oversold signal For us, that you can get as aggressive as looking at the 1 hour chart with the edge signal in this zone, trying to see, okay, where do we see that we're now truly oversold on the 1 hour chart, expecting that slight move up higher, and being very quick to take profits in the event that you get some of these moves up, where you can start to play with essentially a risk-free position. That's how I'd be looking at playing this. I think one other thing that I'd also like to call out in terms of expiration cycles is very soon here, you're now going to be breaching into the November monthly cycles, where you have the election risk also as well. And so I think trying to get ahead of November may be useful in terms of not overpaying. That's still 146 days out, but I do expect that volatility starts to pick back up as we approach November. And so that's where using something like the 20 days, the 30 days to expiration for essentially right now seems to make a good idea in trying to play these quick moves based off of what price action tells us. Now, for the Nasdaq, this cluster is really the most exciting place. We saw on the day trades that the Nasdaq was the one where buyers were still willing to step in. Obviously, looking at the chart, the Nasdaq looks the healthiest out of the 4 indices, but also on the Nasdaq, what should stand out is the same volume thing, right? We had 3 volume breaks, all above that 50-day average, all on a bearish side, suggesting that you may still see price continue to correct at least a little bit more. Now, if I move this over to the DIA, the Dow has broken past its previous symmetry as well, and now the level that stands out, even with this close below 618, is that 50% retracement zone, which is 238.99, which also happens to overlap real nicely with our anchored VWAP from the absolute pivot low. This is sort of the favorite anchor point that I currently have. In most cases, you'll notice that price action is a good distance away, but I don't think it would be all that far-fetched to see price action make its move down here in really just a few swift days, where it happens in a blink of an eye. And if you don't really have a plan, then you'll sort of be just sitting there like a deer in the headlights with fear, thinking that, okay, the markets are now going to retest these previous lows. And my opinion is that the Fed will continue to step in all the way down to these levels, preventing us from actually breaking all the way down. Right, so coming back to the Dow here, the Dow also very similar in the sense of we haven't broken to new highs. We had a fairly weak close on Friday, which again suggests that you would make a move down towards this 50% retracement zone, which in the Dow gives you sort of the best edge, if you will, in terms of a low risk play. Now, again, it depends on how you look at risk, because the Qs, on the other hand, give you a very nice cluster. One other thing which I forgot to mention on the Qs is, again, if this cluster doesn't hold, so now if we do break outside of 234.56, which is the very last level that we have, that's where the Nasdaq would suddenly become my favorite bearish play, mostly because we've broken all of the symmetry which has currently existed, and then I expect a semi-hard retest down towards at least our previous anchored VWAP line, or if we load in the other corrections as well, what you should stand out here is if we bring in the 618 and the 786, both of those are in the zone between this anchored VWAP, really giving you this nice-ish area in which you're expecting price action to fall if we do break this 234.56 area. Now, finally, on the IWM here, IWM, if we draw the same sort of extension, there's only one place of symmetry that lines up, which also happens to overlap pretty nicely off of the 50% retracement zone, where we've already bounced into once, bounced from there, and now we're waiting to see whether or not that happens one more time. Same volume condition stands out here, but something that should be a little bit different on the Russell compared to, say, the S&P is we had volume decrease in this bearish zone, right? If we take a look at that compared to something like the SPY, in which you had volume which is fairly consistent as peaks. If you look at the Qs continue to increase volume on Friday. And then if you look at the Dow, same thing, right? Peaks compared to now, if you look at the Russell is the one in which volume has been high, but if you looked at it on a relative scale, it's been falling, all suggesting that this 50% zone may actually end up being a nice place, especially if the anchored volume weighted average price can continue to drift up higher. And we see this nice confluence in that 135 zone from which the markets again continue to bounce. So those are the bullish scenarios. I think for the near term, I would still be expecting a little bit more bearishness come Monday or Tuesday, at least the beginning of next week. But on the overall, the thesis for me is still, the bullish thesis is still intact, in which I think that the Fed is really going to come in, keep propping prices up, and really continuing to drive the market up higher. And I think these levels give us a plan on how we and I think these levels give us a nice way in which we can go ahead and tackle this trading. Now, if you start to look at some of the top holdings, one example is Intel. So if on Intel, actually, I'll anchor this to our previous low, which was 316. So I'll adjust this line, right click, and we bring this down from March 23rd to March 16th here. Click apply. Using that anchored VWAP on Intel, we should notice that we've fallen directly into that volume weighted average price, but we've also done so on fairly high consistent volume with one really large spike. We've also broken past that area of symmetry, which really, when what should happen doesn't happen, is a sign in itself, where we expected price to bounce from here, only got that small bounce, but then ended up breaking down. Now, of course, this is only one symmetry zone, so it's far less interesting compared to something like the Nasdaq. But that's where I think you could also start to use things like the anchored VWAP. You can even go so far as to create a scan in which you have the date of, say, March 23rd, and you're now looking to see where has price corrected to on some of these higher weighted holdings within the larger ETFs, where you may still have a greater edge than the actual broader index market by itself. All right, so I hope that helps to give everyone some ideas, some levels, a different perspective on where we expect the market to go, what we expect the market to do, and still the overall bullish thesis, and then looking for these smaller zones in which we're expecting price to start to react from, along with having very specific trigger zones and trigger criteria, which is again the edge signal, to confirm these overbought or in this case oversold conditions prior to entering too early. If you're looking to be a bit more aggressive, you can scale down to something like the 1 hour chart. If you're looking at being a bit more conservative, you can continue to use something like the daily or even the 4 hour chart as a proxy for the daily chart and try to get ahead before price action reverses without you in it, and then it becomes a little too difficult to still enter. All right, have a great weekend, everyone. Take care. Hope you have some time to at least de-stress away from the markets, get away from the screens, refresh, and get ready to tackle next week. We'll see you in the next daily update. Take care, everyone.